Welcome to the Ellsworth Advisors January 2026 monthly video. I'm Patrick Justice, here with my colleague Cameron Mealy. Today we're going to talk about how portfolios and markets did in 2025. We'll also look forward into 2026, see what we think moving forward. Cameron, do you want to kick us off with some economic data?
Perfect, will do. Thank you, Patrick. And good morning, everybody. As Patrick said, Happy New Year. Hope everyone is well out there. For context, today is January 9th, Friday, January 9th. So we're still coming out of this information void that we had due to the government shutdown in October. So still catching up on numbers, but a couple of big numbers that we'll talk about, really some surprising numbers. Let's start with GDP. On December 23rd, the Bureau of Economic Analysis reported that according to its initial estimate, GDP in the third quarter increased at an annualized rate of 4.3%. This compares to a 0.5% decline in the first quarter and a 3.8% increase in the second quarter. Another interesting data point that came out with this release, profits from current production increased to $166.1 billion in the third quarter compared with an increase of $6.8 billion in the second quarter. So certainly by the measure of GDP, the U.S. economy is humming. What is more interesting is if you look at that growth that you project out to the fourth quarter. Yesterday, January 8th, the Atlanta Fed's GDP Now forecast model was updated to predict fourth quarter GDP will increase at an annualized rate of 5.4%, which is a huge number. Again, we've talked about this before. The U.S. is a $30+ trillion economy. 5.4% growth, annualized growth is a huge number.
That's a big number. And, you know, it's funny how quickly things can change in the markets, right? We go through Liberation Day, we think the world is ending. What's going to happen with this global trade policy? GDP numbers don't look as good. And now I'm talking about 5+%.
We're talking gangbusters growth. And I can think, again, it goes back to a theme that we have discussed ad nauseum, and that is the resilience of the U.S. economy. I've called it before. I didn't come up with it, but, stolen it from other people. A multi-headed hydra is the U.S. economy. When services are down, manufacturing is up. We have the whole AI revolution, telecommunications. I mean, the industry is just very diverse.
Yep.
And now it really seems like the growth engine, we've hit the accelerator. Obviously, when it comes to growth, we're now concerned about inflation.
Yep.
And inflation, coming out of COVID, with everybody getting back to work, with the money that the government pumped into the economy, we saw the tentacles of inflation take over. That's hurt affordability to many consumers. So when we look at inflation, we really right now only have one hard number from the U.S. government. That is the Consumer Price Index. On December 18th, the Bureau of Labor Statistics reported the Consumer Price Index increased 0.2% in November. Now, this is the increase from September to November because we did not have the October data because of the shutdown. So up 0.2% over 2 months. On a year-over-year basis through November, the index is up 2.7%. Still a little aggressive, not where the Fed wants to be, but this is down from 3% for the 12-month period ending September 2025.
Yeah, that's, we've gone through, obviously, the last several years, a huge rate hike that Jerome Powell had to put in place to curb some of the money supply you just mentioned. This 0.2 bump for a month standpoint, pretty standard, right?
Yep.
This 2.5% to 3% range, pretty normal.
Seems like we're range bound.
Correct. So they've said for years they want to try to get to this 2% target. We'll see what happens with the Fed here over the next, call it 6 months or so. It certainly sounds like Trump has an idea where he's going with the Fed chair moving forward. They think there's some room for cuts. We'll see what that looks like, but I'm okay with that. I think that's it seems like it's in that band.
Yeah, biggest issue we're seeing right now is very strong growth, inflation moderating, staying kind of range bound. But what's interesting is we're seeing growth without jobs.
Yeah.
And so that's the last number. The December jobs report actually came out this morning at 8:30 a.m. The Bureau of Labor Statistics reported that the U.S. added 50,000 jobs in December. This is slightly less than the consensus of about 70,000 jobs. The unemployment rate stands at 4.4%. So when we look 2025 was a very strong year. Obviously, AI drove a lot of it. It was definitely a market of the haves and have-nots. Value was not in play. AI tech was in play. It's a theme we've seen before. So I think when we look at 26, we're preaching a little bit of caution. Valuations have gotten aggressive. The economy appears to be strong, but job growth seems to be waning.
Right.
So again, we're kind of in this Goldilocks situation where the economy's good, not great on the jobs front, good on growth, inflation's ticking up. And to your point about President Trump, the consensus estimate is he's going to be picking a new Fed chairman. The consensus estimate right now is that there will be 2 rate cuts next year. I, for one, view that as aggressive. The president is obviously someone who feels that when you have growth, growth can mask a lot of problems. It can make up for certain issues. So President Trump is certainly deficits, and we're seeing that, frankly. We're seeing that the growth, the increase in tax rate, the tariffs, they are bringing monthly government borrowings down, which is a good thing. All of us know if your household, you can't run a deficit into perpetuity, you will go bankrupt. If you're a company, you can't run a deficit into perpetuity, you will go bankrupt. So why can the U.S. government do it?
Yeah, I'll be really curious to see how job numbers look as we head into 26. Obviously, we had a big downward trend in government jobs as the administration is trying to reduce government, right? So that certainly impacted jobs numbers. I'll be very curious to see what the private sector job numbers look like as we head into 26.
Absolutely. So, from an investment theme in 2026, there's a potential government shutdown, which could create some volatility. We've got midterm elections. That always creates some volatility. The growth seems to be there. Are the jobs going to be there? The market is definitely broadened out. So really strong performance by the Dow in 2025. As anybody who knows us knows that we're more value players. We're looking for real earnings, real companies, real balance sheets. But I think the most fascinating thing that we are going to follow, and we're going to talk about it ad nauseum, is AI. I was reading an article this week that said that there's an expectation that AI-related businesses will spend $4 to $8 trillion by 2032 on AI. And that's not just on chips and software. That's on infrastructure. That's on people. That's on data centers. That's on fiber optic cable. There will be broad. The AI revolution is going to ripple through the economy. And much like we saw in the late 90s and 2000s with telecom, it is certainly game-changing. But much like we saw in the late 90s and early 2000s, what happened to MCI?
Yep.
What happened to Quest Communications? What happened to Lucent Technologies? What happened to all the CLECs, the local exchanges that came up? They're all gone. So there's going to be winners and losers with AI, and we just cannot get caught up in the hype. It's going to change the world, but we have to invest in that sector smartly.
Yeah, and I think we've done a good job of that already, and we will continue to stick with principles and fundamentals, right? That is something we want to participate in the upside, obviously, in a revolutionary, world-changing, part of the economy. But we don't want to own all of them, right? We don't want to own the companies that don't make money necessarily, that are speculative. So, yeah, absolutely. That'll be a major theme as we head into 26.
But I also expect 26 to be a good year for investments. I think we will finish higher. It's going to be a bumpy ride. We will finish higher. And let's revisit what happened in 25.
Yeah, sounds like a plan. So let's revisit both December numbers and also 2025 numbers as a total. In the month of December, S&P 500 was down 0.05%, pretty flat for the month. Dow Jones, as Cameron mentioned, up 0.73%, more of those blue chip positions. NASDAQ, which is your more tech heavy, down 0.53%. Russell 2000, which is more of your small cap positions, as we talked about, down 0.74%. MSCI EFA, or international positions, up 2.93% for the month of December. Emerging markets up 2.74% for the month of December. And the Bloomberg US Ag, your bond exposure, down 0.15%, or pretty flat. For the year of 2025, S&P was up 16.39% for the year. Dow Jones up 12.97%. NASDAQ up 20.36%. Russell 2000 up 11.29%. EFA international positions up 27.89% for the 2025 year. So pretty strong year there.
We haven't seen that in a while.
And it's been a long time for the international. We've been waiting for that for quite a while. Emerging markets were up 30.58%. And Bloomberg US Ag up 7.3% for 2025. So pretty strong year on year across the board. Let's transition a little bit to our portfolios and how they did in 2025. And because it's Cameron and I today, we're going to switch it up on Kelly a little bit. We'll talk more, use case of the portfolios, where you typically are holding them, get a little better feel for beyond the numbers, I'd say. Let's start with price potential, which I would call our staple for growth names in portfolios. You'll see this across a lot of your portfolio and client accounts. For the month of December was down 2%, but for the year in 2025, up 34% in that portfolio.
Good year for price.
Very good year. I'll just throw a couple names your way. 2025 gainers. So Celestica, which some of you probably caught on your statements and in your client accounts. We had a 324% return on that position. Was a big driver for us. We recently sold it, actually last week, took our gain, pushed the gain into the 2026 calendar year. That was a big winner for us. In addition to that, Anglo Ashanti Gold was up 77%. Google was up 65%. Goldman Sachs up 54%. There was a bit of turnover in that portfolio. There were 88 trades there. We do frequently see some trades in price potential. It's held qualified, non-qualified, but very good performance on that model this year.
Absolutely. It is, you said it, that is a staple of nearly every portfolio, every client that I have invested. They have some piece of price potential.
Mm-hmm. Yeah, and I'll also add to that as well. Certainly a big chunk of technology in there for sure. There's also a component of energy, consumer cyclicals, which, as you talked about earlier, when you think about valuations, you think about the broadening of the market. Some of those names in there, although we had the growth side of the technology component, some of those other names, there is room for some appreciation in those names as well.
Yep.
So I think it's well positioned.
Well, and to your point, I mean, boring old energy. The amount of energy that we as a, let's call it cutting edge technology society in this adoption of AI and robotics and machine learning, dang, does it consume a lot of energy?
Absolutely, it does, for sure. Let's move on to long-term price growth. Similar makeup to price potential, I would call it, but a little less turnover there. More stable names that we want to hold for a few years at least. For the month of December was up 1%. For 2025 was up 24%. So not quite as aggressive on the tech side, but you still get a healthy proponent of that, and it performed very well. 2025 gainers, Newmont, up 169%. Royal Gold, up 69%. Google, also held in that portfolio, up 65%. First Solar, up 48%. A big focus, once again, technology, not quite as much, but also materials, communication, and energy. So I feel good about, the diversification in that model as well. I do. Let's move on to our SMID model. That's our small and mid cap allocation. This is the one that I would call it the most interesting year in 2025, right? So it had an excellent year in 2024, outperformed. This is a small and mid cap company portfolio, right? So it's high risk, high reward. Typically, we're holding this model in qualified accounts. There is a lot of turnover in this portfolio. If a position does well, we're typically going to take our gains and run. If it's not trending in the right direction, we're gonna cut our losses and move on. So there were 152 trades in that model. It's an active one. It was up 2.5% in December. It was down on the year in 2025. I have a very interesting note here. So when you compare it to the Russell 2000, the names, and this is our benchmark for this model. When you think about the Russell 2000 in that small cap, there were 146 names in the Russell 2000 that were up over 100% in 2025. 102 of the 146 did not produce positive revenue in their business. So this is pure speculation. in that Russell 2000 index. Nearly every name that we hold in SMID right now has positive earnings. There's a few names in there on the speculative side, but it is stable, small to mid cap names that actually produce revenue. So I'm not surprised that it lagged in 2025. These are models and names that I love to hold in Roth accounts, for example. These are long-term holds where we want some juice in the portfolio and we want growth from it.
Yeah. But to your point, you've got to expect in this account, when accounts we hold SMID, there's going to be volatility. There's going to be turnover. Again, we do not hold normally this portfolio in taxable accounts because of all the capital gains we're generating. And with small stocks, you're going to get volatility. And clearly, 102 stocks going up more than 100% that don't produce any revenue is speculation. I'm certain some of those companies are going to be great companies, but today they're unprofitable small companies, and that's just not that's not where we're going to put client money.
No.
So that portfolio suffered. We could have been more aggressive with it, but as all of you know us, with your money, we're just not going to be that aggressive.
Absolutely. Let's move on to our dividend yield model. For the month of December was down 0.25%. In 2025 was up 5%. Few names there that stand out in 2025 gainers: J&J, Johnson & Johnson, up 43%, Cisco up 30%, AEP up 25%, and Amgen up 26%. Laggards: Public Storage was down 13%, Packaging Corp down 8%, Bristol Myers down 5%. You'll get a mid turnover in this model. There were 25 trades for the year, but relatively pretty stable on our holdings there. Big swath of healthcare, financials, energy, and utilities. I will point out something very interesting. As it sits right now, the pure dividend yield on that model is north of 4%. Meaning that,
Great income.
and just to explain that further, meaning that if prices, if market value on the positions were stable for the year, we're going to yield 4% on that model on those 20.
It's like owning a treasury.
It's a very stable model. I've always thought of this as a ballast for the portfolio. If we did happen to go into a drawdown period, those are the names that we want to own. And this is another model that you'll see across most households are going to have
This is absolutely a building block portfolio, like price potential. And again, every single company that we hold in there, I can tell you exactly why we hold it. I have strong conviction. They're great companies. They've got good balance sheets, strong cash flow conversion. We can go on with why we like the companies. But in the new economy, they're boring.
They are boring.
Well-valued businesses. And they are a little out of favor right now, but they are going to continue to be one of our core holdings because when there is a correction or when there is an adjustment, that portfolio will do very well. It's had way more great years than it's had disappointing years.
Absolutely. Moving on, two more. Growth with income model for the month of December was up 0.8%. For 2025 was up 16%. So pretty steady year there as well. And that allocation, just to dig one layer deeper, it's roughly a 60-40 mix right now. So you get roughly 60% equities, 40% fixed income in there. There is a commodity component as well, which has done pretty well. And I think that's certainly there's a use case for that heading into 2026 as well. Absolutely. On the commodity angle. A couple names in there. We do own pure gold exposure for 2025. It was up 64%. Raytheon was up 58.5%. J&J is a crossover holding in there as well, up 43%. Nucor up 40%, and NVIDIA up 39%. Laggards in there. Lennar was down 25% in 2025. Nike down 16%. They've obviously had some changes in that company and some struggles there, but I think certainly is
it's the best brand in the world.
It is. EOG down 14%, and Digital Realty down 13% as well. So very steady allocation. There are only 4 model trades in the growth with income holding, and I feel great about some of the financial exposure. There's a little bit of tech exposure in there, but a nice, healthy commodity exposure. Once again, another stable, well-balanced model for client accounts. Absolutely. Last one I wanted to touch on, appreciation with income. For the month of December was up 0.25%. In 2025 was up 21% for the year. Gainers in that model for 2025, Lam Research up 137%, Amphenol up 95, CVS up 77, and Broadcom up 49. Laggards in there, Energy Transfer was down 16, T-Mobile down 8. Total trades on the year was 36, so somewhere in the middle as far as the turnover goes. Once again, there's some tech exposure there. There's financial exposure. There's healthcare exposure, energy and industrials. Well-diversified model
Absolutely.
there as well. So that covers our models. As we head into 26, you touched on AI and what that looks like for our economy. Other thematics you're thinking about as we head into the 26 year?
For me, it's what is the Fed going to do? Is the Fed truly independent? President Trump is clearly going to put his person in there,
Yep.
and that person is going to be a hawk. They're going to want to cut. Do we see extraordinarily strong growth in GDP? Do we see that without employment growth? Is it all productivity gains through AI? What is that going to mean for the employment situation? Because eventually, you got to create jobs too.
You do. And, we'll see, as you said, they're pricing in 2 cuts for this year. I feel like the last several years, depending on how many they price in, it doesn't necessarily work out. They have to understand the data. Every time the Fed meets, they look through the most recent data. How are we looking inflation? How are we looking jobs, et cetera? So it's a moving target. I feel like there's certainly some administration pressure, as you said, to continue to cut rates. I think that does add some fuel to the fire in the economy and into CapEx and borrowing ability for companies, et cetera. But we have to take it one step at a time.
Yeah.
And at this point, we stick to our principles. We stick to, thinking about value, thinking about price. We're not overpaying for companies. We want to participate in the upside, but we have to cover the downside. And
Because there will be downside.
absolutely. And that's where on the fixed income side, we're willing to stay short at this time. We'll continue to take a peek at some, intermediate positions, but we like staying short in the fixed income side and thinking about the household in general and meeting our goals. The other thing I would mention as well, we talk a lot about index performance in the S&P and the Russell 2000 just to get a gauge to see where we are from a broad economy. But I always think it's important for clients to focus on their goals and what they need to do and what they want to see out of their capital. That's our job. We are goals-based. We're thinking about them and what's best for them and making sure that their capital is working hard as it should be.
Yeah. There are many ways to reach your goals, and it doesn't always have to be, did I beat the market? Because the markets are 100% equity exposure. And I don't care how young you are, how aggressive you are, we're never going to have a client who is 100% equity exposure. That's not the way we look at things. We look at the holistic picture, and we want to have some stability behind it. So, we expect 2026 is going to be a good year. It's probably going to be volatile. Again, midterm elections, there's a lot riding on it. It'll probably get ugly. There's going to be a lot of mudslinging, but you just got to stay the course. And if you have a long-term outlook, you're going to be fine. So Happy New Year. Welcome to 2026. We appreciate the trust you've placed in us. And if you have any questions about your accounts, please don't hesitate to reach out to us. We will see you again in a month. Have a great month, everybody. And we will talk to you in February.
Thank you.